Okay, so in this chapter on financial statement analysis involves comparing a firm's performance with that of the other firms in the same industry and evaluating trends in financial position over time. Managers use the financial statement analysis to identify situations needing attention. Potential lenders use financial analysis to determine whether a company is creditworthy, and stockholders use financial analysis to help predict future earnings, dividends, and free cash flow. And potential investors use the financial statement analysis to make well-informed decisions about investment. And Okay, so in this chapter, we're going to cover ratio analysis. So we'll talk about various ratios. Also, we'll have a quick discussion on common size statements and percentage change statement. And then we'll also talk about DuPont equations. We'll discuss limitation of ratio analysis and what other factors that you should focus on when you're making an analysis of a financial statement. The intrinsic value of the firm is determined by the present value of expected future cash flows and discounted at a weighted average cost of capital. So this chapter explains how to use financial statements to evaluate company's profitability, required capital investments, business risk, and the mixture of debt and equity. So the ratio, advantage of ratio, we talk about it, and let's begin with the financial statements, which includes an income statement. First, let's start with, so this is company's income statement for the year 2019, and for 2020 is an estimated value. So is the balance sheet, the asset portion of the balance sheet, and this is the liability and equity component of the balance sheet. And the other data is EPS, earning per share, then dividend per share is there, book value per share, dividend number of shares outstanding, the stock price is provided, and company makes a lease payment in an extent of 20 million, and tax rate is there. And we are now calculating various ratios. And let's start with the profitability ratio. What the profitability ratio is, what is the company's rate of return on sales, and that is captured by profit margin and operating profit margin. And what is the company's rate of return on assets? If you want to know what is the profit on asset or rate of return on asset and rate of return on sales. So the rate of return on assets is known by the basic earning power ratio, return on assets, and return on equity. How do we measure the net profit margin? Net profit margin is net income divided by sales. So net income is $390 million, and this is the sales level. So the profit margin is 5.9. And this chapter, this table has the various profit margin ratio over a period of time with the industry average. So the company's profit margin ratio is lower than industry average. However, it also fallen from 2018 to 2019, but estimated 2020 profitability ratio shows little improvement. And the other ratio is operating profit margin, which takes into account, EBIT by sales. So earning before interest and tax divided by sales. You can see a profit margin takes into account net income, while operating profit margin has an earning before interest and tax. And this profit margin ratio identifies how a company is performing with respect to its operations before the impact of interest expenses is considered. So that makes the comparison, easier. Basic earning power ratio is earning before interest and tax divided by total assets. So this is how it has been calculated, and the value is 12.4. And as the equation goes, that includes earning before interest and tax. So it removes the effect of taxes and financial leverage, and that is useful for comparison of firms with different tax situations and having different degree of financial leverage. So that effect will be removed. Okay, what is projected is projected below the industry. So it shows a room for improvement. So they can improve uh, on earning before interest and tax. In order to increase this, they can increase earning before interest and tax. And maybe with the proper efficient utilization of assets, that ratio can be improved. Another ratio is return on asset and return on equity. So the return on asset is net income divided by total assets. So what it calculate is is calculated by dividing net income with the total assets, and this ratio is below industry average. So the low why this low is return is low is due to company low basic earning power. So probably earning before interest and tax is lower, and also higher interest rate expenses. Right, so earning before earning before interest and tax is lower. Basic earning power tax is earning before interest and tax. If this is lower, and if this is lower, it is because there might have more high interest costs resulting from above average use of debt, and also having low earning power. Right, both of these factors contribute this relatively low net income. Uh, we and that's why that ratio is lower. The return on asset user denominator, we have a total assets, while in return on equity we have common equity as a denominator and net income as a numerator. The return on asset is net income divided by total asset. His return on equity is net income divided by total equity. So that is 12.12, 12.2. However, it is still below the industry average. Is uh, is probably how company is doing in accounting sense, and this is below the industry average. But it says the company is doing better due to company's greater use of debt, right? Proper use of debt, and we'll see how the debt is helping in improving the return on equity in second, right? So over a period, so the below is still both below average but improving. So return on asset is lower by net interest expenses, and that lowers net income, which also lowers return on asset. So use of debt lowers equity. However, the use of debt lowers equity, and if equity is lower than net income, so if the equity is lower, if this denominator is lower than net income, then obviously return on equity shows increase. Okay. Another kind of ratio is asset management ratio. So that shows how efficiently firm uses its assets and how much does the firms have tied up in assets for each dollar of sales. The first ratio is inventory turnover ratio. It is cost divided by inventory, so cost of goods sold divided by inventories. And since the book considers the cost of good excluding depreciation, we have to add back the depreciation. So depreciation is added back, and you can see there is an improvement of inventory turnover ratio over a period of time, but still is below the industry average. But that suggests that is improving is a good sign. Well, uh, it suggests that microdrive is holding too much inventory, and high level of inventory add to net operating working capital, which might reduce free cash flow, and which further leads to lower stock price. And low inventory turnover. So in addition, microdrive's low inventory turnover ratio makes us wonder whether firm is holding obsolete goods not worth their stated value. But that is a further future investigation. But you see the high inventory turnover is means either company is holding uh, too much inventory, still lower than industry. So it means that they are holding too much of inventory because denominator seems to be larger, so too much of inventory. However, this is improving inventory turnover ratio is a good sign, but still it is lower than industry. It is improved from previous years, but below industry average. We have days sales outstanding. So that is the receivables divided by average sales per day. And average sales per day is sales divided by 365. So days sales outstanding is 29.3 days. And that ratio is used to, appraisal of the SL, and higher in 2018, but is little lower than industry. So the day sales outstanding is also called as average collection period, and it shows an improvement that is it is increased from 2018 to 2019. So probably customers are not paying in time, but the estimation shows an improvement. So customers take lesser time to pay the dues, but it's still higher than the industry. Okay, so another kind of an asset management ratio, how efficiently firm is utilizing fixed assets, is sales divided by net fixed assets. So that is 1.8. And the total asset turnover, here we have total asset is the denominator. And it is better than previous year, but it's still not up to industry average. Why? Because they might have the high use of net fixed assets, right? And total assets is more. So this is more related to sales. As a result, you're not showing an improvement in the asset turnover rate, the fixed asset turnover rate, fixed asset turnover and total assets turnover. Another important ratio is the liquidity ratio. So what the liquidity ratio suggests, it it it, it helps you to decide whether company can meet its short-term obligations using the resources it currently has on hand. And so the ratios are current ratios and quick ratios. So the current ratios is the current assets divided by current liabilities 1.9 quick ratio that takes into account most liquid form of current assets. So you're subtracting inventories from the total of current assets to get the quick ratio. And still it is expected to improve, but is still below the industry average. So what you can say is usually, current assets should be higher than current liability. The quick ratio, so this is still a better, good is improving. Current assets is getting reduced, and current liability, but still the liquidity position is weak if you compare with the industry. Debt management ratio is helpful in deciding if the company has too much debt. Can the company earning meet its debt servicing requirement? So it's kind of long-term solvency ratio, right? It's a short-term liquidity position. Let's talk about long-term liquidity positions, right? So the leverage ratio is the debt ratio, is the total debt in the total assets. So it is 24% higher. The debt ratio is a good sign or bad sign. You see with the industry, but that means that company has to have more obligations to meet, and the company fails to generate the income to meet the obligation, then the risk of bankruptcy will be higher. And another kind of an indication that you get that how much is the total debt in comparison to the equity. So the debt equity ratio is 37.5. Liability to total asset. What is the total liability and the total asset is 13.6. Okay, you want this denominator to be greater than numerator, otherwise it increases the risk. Equity multiplier is a ratio. It shows the factor by which the return on asset is multiplied to determine the return on equity. So if equity multiplier is total asset divided by common equity. So greater the ratio, which is greater than 1, indicates the firm is having more debt than equity. So a high equity multiplier indicates a company is using a large amounts of debt to finance assets. That is an equity multiplier. Time interest earned ratio is that's showing extent to which company has operating income to meet the interest expenses. And that is 6.2. So still it is greater than 1, so it's a good thing that company has the EBIT, earning before interest and tax, 6.2 times higher than the interest expenses. So the company can meet their obligations of interest expenses and if it is less than 1, then it is a risky sign. So if that is declining over a period of time, it's not good. EBITDA coverage ratio, uh, that ratio is also used by firms to assess a company's ability to meet interest charges on its debt. And since the debt coverage ratio that we have seen, TIE ratio, time interest on ratio, is useful, but it has two shortcomings. One is that interest is not the only fixed financial charge. Company must also reduce debt on schedule, and many firms lease assets and thus must make lease payments. Failure to repay debt or meet lease payments may force them into bankruptcy. And second, the shortcoming is EBIT, earning before interest and taxes, does not represent all the cash available to service debt, especially if a firm has a high non-cash expenses like depreciation and amortizations. So that is added back here. So it's the lease payment, and the denominator is interest expenses. Then we have loan payment and the lease payments. So that is a better coverage ratio. This is a better coverage ratio, would take all of the cash earning into account in the numerator and other financial charges in the denominator. And this ratio is most useful for relatively short-term lenders such as banks, which rarely makes loans except real estate backed loans for longer than about 5 years, and over a relatively short period, depreciation generated funds can be used to service debt, and over a long time, those funds must be reinvested to maintain the plants and equipment, or else company cannot remain in business. Therefore, bank and other relatively short-term lenders focus on EBITDA coverage ratio, where the long-term bondholders focuses on TIE ratio. So this is the results being tabulated uh, against the industry versus industry, and you can see here it is improved but more debt than industry. So it has more debt than industry, more risky. The company is more risky in investment. Okay, so the market value ratio refers to or relates a firm's stock price to earnings, cash flow, book value per share, and these value ratios are a good way to measure the value of a firm's stock relative to that of others. And market value ratio incorporate the high current level of earnings and cash flow increase the market value ratio. That's true. High expected growth in earnings and cash flow has direct relationship with market value, and high risk of expected growth in earnings decreases the market value. So the growth in earnings increase the market value, but the risk decreases the market value. They are the ratio, price earning ratio, we have 16.8. What is the is calculated by dividing price per share with earning per share. The meaning of price earning ratio is how much investor will pay for $1 of earnings. Higher the better. So they pay $16.8 of for 16.8 times more than $1 for every dollar of earnings. And you can see the Amazon price earning ratio and Microsoft price earning ratio. Amazon is having higher price earning ratio. Uh, uh, Book value per share ratio, you are dividing common equity with the shares, and market to book ratio is market price per share divided by book value per share, and that is 1.53. And always, when you find the market to book value ratio which is greater than 1, it's good. It's a growth company. And if the market value to book ratio is less than 1, it's considered to be a value firm, right? And some investors try to find the value firm, so market value is lower than book value, so that it is cheap to buy, and they can appreciate in value over a period of time. If the fundamental is sound, using ratio analysis, you can figure out the firm with having the value firm with lower market to book ratio, which is less than 1. The price earning ratio, if you compare with the industry, then price earning ratio and market to book ratio indicate the market doesn't value the company as highly as industry. So you can see the company is not a great performer in terms of industry performance. It's not a bad as well, right? Now, when you prepare common size statements, common size balance sheets, you are here dividing all items by total assets and talking about in the total asset category. The common size balance sheet liabilities are those components of the liabilities expressed as a percentage of the total liabilities and equity. And what can you analyze from the common size statement is what is the proportion of net asset in the total uh, net assets in the total assets, or net fixed assets in the total asset, like each of the component of the fixed of the assets in the total assets, and the liability that has 24% of the notes payable and long-term bonds of the asset, which is higher than industry combined percentage of 20%. Income statement, you are dividing all items by sales, so it is now expressed as a percentage of sales. The profit margin, based on this common size income statement, the profit margin is less than industry ratio, and the company has lower other cost, or it has higher cost of goods sold. Uh, so the cumulative change is percentage change analysis from the previous year. So 2018 is the base year here, right? Base year, and calculate any change in the sales is, let's say, base year is assume that is X, and 2019 it is Y. So this percentage change is Y minus X divided by X multiplied by 100. So if you look at the information in the balance sheet of 2018, 2019, and 2020, you can calculate the percentage change over a period, right? And so that helps you make a comparison uh, from the base year. So sales grew 9% in 2019, net income. So you can see and comments on the growth percentage or net income growth or sales or other kind of thing. So it's an asset class has gone down in relation in comparison to 2018. If you want to make a comparison against having base year 2019, you can do it for 2017, so that will become your base year. And this is what the analysis uh, from the percentage change balance sheets and other financial statement, and from the projection as well. So the small cumulative increase in total assets compared to 2009 in total asset 20.1%. So big reduction in cumulative inventory growth, which is 6% in 2020 estimate versus 13.3 in 2019. So likewise, those comments you can make. All right. Another, important piece of ratio is the dew point equation. It is tying the ratio together. So it ties other ratio, and those ratios are reconfigured. Return on equity ratio is the three ratios are reconfigured into return on equity, and that is profit margin. So dew point ratio focuses on profit margin, total asset turnover, and equity multiplier. So it covers uh, expense control, asset utilization, and debt utilization. So it shows how these factors combine to determine the return on equity. And you see here, the different ratio is useful in knowing how do managerial actions affecting the firm's profitability, asset efficiency, and financial leverage interact to determine the return on equity. Uh, So the managerial actions affecting profitability, asset utilization, and financial leverage. So those three ratios interact to determine the return on equity. All right. So it is important, a performance measure important for investors. So equity multiplier. So if sometimes you are interested in the return on asset and leverage, it is combining these three. Right, managerial effectiveness on various performance to determine how companies performing well in profit margin, asset utilization, and you have the return on equity, right? Return on equity. So uh, this is how you calculate the return on equity. So you can see there's an improvement on profit margin, asset turnover, and the return on equity as well. So compared to 2019, there is a profit margin has substantially decreased. So as the asset utilization has also fallen, only the return on equity has increased, right? So it has gone down because there are two-way area where company is lagging. Estimates show some improvement over previous years, but still return on equity is not getting a significant boost. Rather, it has predicted to be falling. All right, the industry ratio is significantly higher in profit margin, asset turnover, and return on equity is relatively lower. The company is higher, is probably high use of debt in it, right? Uh, and and uh, so it is lower in comparison to industry. So uh, what is the potential problem with the ratio analysis? We calculate a number of ratios, right? Uh, Now, one of the benchmarking that we did is comparing with the industry is difficult. If the firm operates many different divisions, right? If the company having different divisions, then it's difficult to make an industry comparison. Seasonal factors can distort the ratio. Window dressing technique can make statements and ratio look better than you know. And different accounting and operating practices can distort the comparison. And some of the qualitative factors that also you should take into account in addition to the ratio analysis uh, that we carry out is the qualitative factors. The revenue tied to a single customer is very risky. Tied to a single product, to a single supplier, and high percentage of business is generated overseas, that is also the cause of problem, and that creates more risk. So you should dig deeper, not only focus on numbers, but look at the quality of factors. Also, you would like to know what is the quality of management, what is the futuristic plan, what is the vision of the company, what's the future growth prospects, what is the competitor situations, what is the growth of the industry. What is the product life cycle of industry? Is it declining, maturity, uh, or what products are in pipeline? What are the legal and regulatory issues that companies encountering? This all matters when you make an analysis. So it should be a combination of quantitative analysis and a qualitative analysis to get a better picture uh, about the financial position of the company. And one of the things that I would like to tell you is that the book comes with the Excel toolkit that shows all the calculation uh, done in the chapter, and you can hover over the Excel toolkit that is available for you to download as a student resource on the book website. Okay, and that shows all the calculations, how it is being calculated, how to use Excel, those figures, and find out various ratios and all the ratios that we discuss, we talk about. And it also contains an solution to self-test and also some mini case data which you can work along and can find the ratio referring to the discussion in the chapter in the Excel spreadsheet with the chapter Excel, worksheet in the spreadsheet, and then you can work on in order to test your knowledge. You can work in the mini case spreadsheet to find the answer for those cells. All right, that's it from my side. Thank you.